Did you know there are stocks right now paying dividends that are double the current cash rate? And here's the kicker, many of them are sitting at major lows. So if someone told you that you have to choose between income or growth, think again. Because tonight we reveal 10 growth stocks on the ASX that are not only paying out incredible dividends, but also have serious potential for double-digit upside. Plus, we break down NAB's latest bombshell call on interest rates in May and dissect major news coming out of one of the biggest tech players on the ASX and why now might be just the time to jump in. Now, if you want to trade with more certainty than over 95% of traders, you've come to the right place. Welcome to Wealth Within's Australian stock market show. With over 2 decades of experience training over 30,000 traders, we bring you what actually works in the stock market. I'm Philip Tortevsky, and joining me is Wealth Within's professional traders Janine Cox, alongside Wealth Within graduate and global head of premium business at Blueberry Markets, Zoran Kresovic. Good evening.
Good evening. How are you?
Good evening.
I'm good. I'm glad I got that out. How are you, Zoran? Welcome to the show.
Thank you.
Yep.
It has been a while, hasn't it?
It has. Good to have you on the show.
Thank you.
Yes.
Thank you for having me.
Yep, Zoran's an expert, as we mentioned, out there at Blueberry, so he's going to provide some great insight in terms of these stocks moving forward. Anyway, let's get straight into it with the RBA looking like it's going to cut rates this month. Yield becomes a major point of interest right now. So let's discuss yields and the best play for investors moving forward, Janine, because I want to start with two things here. First, there's that discussion that you can't get income and growth. And right now, obviously, Labor's in power. A whole different set of rules with what Liberal were planning on coming in with. What sectors do you see are the ones that are going to provide the income moving forward? And can you get that growth and income?
Well, how about we just put the politics aside? Otherwise, I might have to get the boxing gloves out again.
I'm surprised you didn't bring them. No.
Look, in saying that, we need to really think about the cash rate. If people are relying on interest for their income going forward, I think you're going to have to look further and look to the stock market, because at the moment, obviously, there are predictions about what's going to happen to the cash rate, and it looks like it's only going to go down, which means that obviously interest at the bank will go down. But it also means that stocks will go up, which is a great thing. So there's a really good time now for setting up for growth and income going forward, which is what we've been saying all along. And we're seeing lots of stocks that are at lows, aren't we, that are offering really good dividends, plus banks, always offering healthy dividends. Yeah, you just took the words out of my mouth, and I'll get your thoughts real quickly. Obviously, the market has come off about 30 odd or 20 odd percent since those falls in February, March. Which sectors are you seeing with the potential for the best income moving forward?
Well, just to actually go back on what you just mentioned now, the market has actually bottomed out in early April. I believe it was 7th of April lows.
Yep.
But it has actually somewhat rebounded already. And, whilst a lot of investors are waiting on the sidelines at the moment, what we're also seeing is the market is actually 6.5% to 7% of its all-time high again. So the longer that you kind of wait on the sidelines, the longer it might actually take for you to make the decision, and the market move actually could continue to go further up. So with interest rate, obviously, decision coming into effect, obviously, I believe on 20th of May is the RBA interest rate decision. We're probably pricing in 25 basis point interest rate cut. And also on top of that, we're looking at another 2 or 3 interest rate cuts until the end of the year. So we're looking actually potentially a full 1% of cuts. We're probably looking at stocks or sectors that are, interest rate sensitive for the growth aspect, but also maybe combine that with some of the big players or top 20 stocks that are actually providing a good yield, so you can kind of capture on both and basically capitalize on that.
Yeah, now we're going to cover off some great stocks. In fact, we're going to show you some stocks that are trading at some serious lows plus providing double-digit income. So you best be stay tuned for all of this. So we'll start with you, Zoran. We'll get into the workbook and have a look at our first stock, which I believe is in the materials sector, if I'm not wrong.
Helia Group,
yes. So looking at the chart, obviously on monthly basis, it had a strong upside move and obviously retraced quite a bit over the past few weeks, but it's actually had a strong rebound to the upside. And if you focus on the weekly chart in itself, obviously it did have a big gap where the market gapped on the week ending of 28th of March. Now, the positive and good thing here is obviously the stock has actually rebounded. It's rebounded quite strongly, and it looks like actually it's hovering around the nice round number of around $5 resistance level. If it can hold around these levels and continue to actually push higher, then I'm not discounting the fact that it could test the all-time high around $6.10. So I'd be probably looking at, in a shorter term, maybe a bit of a consolidation would be helpful on weekly chart, anyway around $4.20 to $4.40. But then hopefully we can see another upside run and go towards that $6 level.
Yeah, now I'll just get your thoughts on this one quickly, because it's paying almost a 17% yield, and you're looking at a chart there, to me, that's in an uptrend. So, that dynamic isn't always around when you're looking at prices or companies that pay huge double-digit yields. Generally, you see the share price is falling. This is opposite. Thoughts?
Well, look, I mean, it has fallen and it's been rising, as you say, to fill that big gap on the chart, which is interesting because it's created this huge level of support underneath here. I can just draw my line across there, and it's a nice baseline for this share, but it could come back, as Zoran's saying, just to do a little bit of a test of support before it takes off. And I totally agree with what you're saying in terms of the upside potential that's there. But I mean, this is more a type of stock that's for people who are more higher risk takers. They like a bit more speculation. Just looking at the volatility, we're not talking about a plodding stock here. This is one that's going to give you a bit of a roller coaster ride, because I mean, that's 44% just in a matter of a few weeks in that period. And it's not like it hasn't done it before. You can see back here, and I'll just expand the chart up quickly, where it's risen strongly and it's reversed all the way back down again, which is pretty much what it's done this time as well. But I see this as a little bit of a showstopper at this level here, and it's showing how that there's strength there. Once it gets above that level, I think that it should be on its way.
Yeah, all right, so not for a superannuation type portfolio.
Definitely not.
All right, so next stock.
All right, the next one we've got is Spark New Zealand, which this stock was a beautiful trending stock and really nicely grew from all the way from around $1 up to $5 over time, which was a beautiful return. But look how quickly that was eroded. It just got wiped out. So I think there's some serious potential here on the upside. It fell by about 64%. Has it been oversold? Well, that's really a question for the fundamentals at this stage, which you've got something you want to say on that, Soren?
Well, I'm just looking at the volume, and obviously the volume is drying out on the right-hand side here as the price of the stock is actually falling. But whilst it might provide a great opportunity, in the long term, I would still be probably looking at the monthly chart and focusing on that low back at $1.13 or $13.5 in 2010, because the way it's actually going down right now, it looks like it's a falling knife. My price point or something that I'd be considering or looking at is actually for it to create maybe a triple bottom here or provide quite a bit of support. If you can actually come and consolidate around these levels and start creeping upwards, then there would be probably a point that I'd be looking to get in. But right now, it's creating lower highs and lower lows. It's looking fairly bearish, and at some point might provide opportunity, and I agree with you 100%, but right now I still think there is a lot of concern here as well.
Well, I just want to go in a little bit deeper on that point, because both of you, it seemed like there was a little bit of hesitation. I totally understand it, but I mean, if you're looking at this, and I'm playing devil's advocate from the point of view, well, hey, it's a 12 or 13% yield this stock's paying. It's at what you potentially would consider dirt cheap prices, but the hesitation, and if I was able to guess, that comes from potentially the point of view where timing this stock, and the word timing is so important. I mean, you've seen it so many times with students. You've also seen it being a past student where it's not one thing just trying to jump in because it's a nice yield and relatively cheap.
I guess the difference between someone who hasn't had the training and someone who has is the discipline about getting in and that thought of risk first rather than the reward. Whereas people often look at stocks like this, for example, and think, if you're looking at the chart, you can see it there, and think, okay, I think there's significant upside, but it's just a question of when, really. That's the risk question.
That's the most important question, isn't it? Because you can be sat in this stock it going sideways or still falling, and then think about the opportunity cost of your money.
Well, imagine this. You bought the stock, it goes up and you think, okay, I've got a winner. You're waiting for that dividend and then it falls away before the dividend because you didn't understand the whole prospect of that risk management and when to get in.
Yeah, and that's quite often, which is why having this conversation is so important. Did you want to add anything?
I mean, you guys summed that up pretty much. It's all about timing and making sure that you can see all the red flags that are actually happening right now and ensuring that you have good, sound rules in place and backtest and do everything that you need to do so when the right opportunity does occur, you can actually enter the stock and hopefully capitalize on the appreciation of the stock itself, but also taking the dividend top up as well to help you.
Yeah, getting that golden combination. Now, on that point, I want to bring up Dale's book, How to Beat the Managed Funds by 20%. I hope I'm holding the right book. Yes, it is. Now, this book here is free. You just have to pay the shipping. And a lot of the techniques we will discuss in tonight's show, and we have over past shows, are in this book. It's a fantastic introduction to technical analysis, to portfolio creation. And if you do want to get even more in depth with your studies or wanting to learn about the stock market, visit our website, wealthwithin.com.au. We've got plenty of courses out there and a whole bunch of other stuff. But let's now get back to the charts. Next one. All
right, the next stock we've got is New Hope Corp. Do you want to talk about this one?
I can definitely discuss it, and what I can see here, obviously on the monthly chart, it's very similar to the stock that we previously had a look at it. It's topped up in October 2022. Ever since then, we actually seeing a lower highs and lower lows. So obviously the stock actually appreciated quite aggressively, but it seems to be falling and obviously in a medium to long term downtrend. So I always like to have a look at the stocks on monthly chart first to give me a bit of an overview and understand where the longer term trend is actually going towards. And if we break it down into weekly chart, we've broken some key levels here. So I'll just actually point out right now. So we've gone through the $4 level mark and it's actually broken through quite heavily. It did come back to retest that, it didn't hold it well, and it seems to be continue to come off. So one of these ones again where the trend is down, it's looking fairly bearish right now. I'd be looking for it to consolidate and find a good base in terms of the low. And then obviously work off those levels to see whether we can actually find some upside. But obviously more analysis is required. If you're a student, you can apply a whole heap of things such as Fibonacci levels, gain levels, price levels, and also combine that with pattern and time to give you the highest probability of actually finding a bottom, so you can actually start looking into it for a longer term or medium term, depends how you trade it.
Yeah, sounds like not ready just yet. All right, maybe the next one is.
All right, let's have a look at that. YAL, that's Yancoal Australia, and it's like the one we were just looking at before with Zoran. It's kept falling away, and there was always a possibility that any of these stocks could find support and turn around and go back up. And if you read broker reports, they might have targets on them, and you're thinking, if you're inexperienced, that the broker's saying it should get to this price. Well, when will it get to that price, and how far might it fall before it even gets there? And you might be down 30, 40, 50% or something, and then still not knowing whether they were right or not. So this is where it's about not taking these positions when the suckers are taking them. It's about having that direction right. So you can see that strong support that's happened around this level here, but still nowhere near confirmed yet. But it's paying an 11% dividend, which is really nice. Now, obviously, as the price falls, the yields go up and vice versa. So just bear that in mind. But for a stock like this, are you really going to be worried about a 10% growth? Or you're going to be more focused on managing your risk and you're protecting your capital, and that's, I think, really important.
But on that point, again, playing devil's advocate, with a 10% yield, doesn't that already give you a 10% buffer on the stock falling if you are looking at holding it in the long term? And
well, that's the question, isn't it? That's a really important question, and you've lined me up for this one. He's just done well, hasn't he? But in reality, it's like an if come. So you may never actually get that 10%. So people are buying it on the assumption they're going to get it, and that's what I was saying before about, you get to the point where you're waiting for that yield, and then all of a sudden the stock drops away. But it does provide some sort of buffer when you're getting a dividend to the downside. But do you want to count that? or do you just want to make that the cream on the top? I think I'd rather make that the cream on the top.
Yeah, that's a great point. Did you want to add something?
I agree with Janine 100% here. Like I think at the end of the day, you got to look for the stocks that are obviously got a whole heap of upside and that are trending upwards nicely. And then obviously the dividend component is obviously a top up that gets you from that 10 to 15% return, or if ASX gives you 10% or 11% per annum on average for the last 30 years, then you can actually top that up and beat the ASX and obviously take into account the inflation component as well.
Well, it's nice in theory, but I've rarely met someone who wants to keep holding a stock when it's down 40 or 50% just to get that 10% yield. But anyway.
Well, look, there are people out there who are like that, and that's why they realise that that's not working for them, and then they choose to get educated, really.
Yeah. In light of the volatility this market is providing right now, you'd be hard pressed to find other options. But let's now get to the next stock.
All right, the next stock is WAM Capital. This one's been so sideways and volatile over recent months. I mean, it did have a period where it trended nicely up this rise to the high there that was back in 2017. But since then, it's really struggled and been sold off heavily. But I can see a consolidation occurring now, which could be an opportune time to take a look at this stock. And it's so far, this is one that to me looks the most interesting right now, given the way that it's moving. The question is, where do you enter now? We've been getting higher lows, and at the moment we're getting higher highs, which is a positive sign, but prior to that it was sort of more in line. If we see a move above that high, a more conclusive move above that high, you've still got this point of resistance here, but it all comes down to the bigger picture analysis. Now, people think, okay, we're just drawing lines on the chart to show where the natural support and resistance is, but this is a classic example of where it's not just about the natural support and resistance. It's bringing together, because you have to, at the end of the day, you've got to make a decision about where you're going to get in. Where's the lower risk time to put your money at risk? And to do that, you've really got to have a big picture analysis of on the chart. So we'll go back to the monthly chart. And to do that, there are important points in the history of this stock that are going to give us levels. Now, I won't say too much more than that, other than that you really need to look at what you need to know, and that there is plenty of knowledge in either our short course or our main course for you to get this information. And I love this stuff. This is when you get through module 3, I used to call module 3 the speed hump. It's all the back testing, you put your scientist hat on, and you will be less than 2% of the population that will be able to work out the strategy that works really well for any particular stock. But when you get to module 4, it's like a breath of fresh air, because all of a sudden it's that intuitive side of you that will start to see things on the chart and why particular levels are important. So I can't encourage you enough to go down that path. And looking at WAM, for example, you might think that 170 is the most important level on the stock, but it may actually be a lower level than that, or one that's slightly higher than that may convince you to wait for this level rather than that. You will have heard Phil talk about this on the show quite often. We've done examples where we've looked at a number of levels, and then you might have said, look, I'm just going to wait for it to get through all of that noise before I would take an opportunity in it.
Well, it's about taking the safe trade, not just any trade. And more often than not, if you line up the safe trade, then that's when, the consistency comes into things. So, and I'm sure you've got some advice on this one, because it does look like it seems to be basing out at the moment.
It does. On monthly chart, it looks like actually it's finding its fee, and I think this is what we were mentioning previously, obviously finding the bottom and then price starting to creep up or consolidate for a longer period of time, in a sideways trend. I think the point that I want to raise here is, you guys mentioned about the entry point, but I would just like to say one thing, that given the length of these down red bars, I would also be just as important point would be actually to find out where you want to put your stop loss and what's your exit strategy, because entering the stock, yes, you can do that in majority of times, but getting out of stocks can be quite challenging. And what I'm seeing here is that whilst the stock actually trends up quite nicely, it can pretty much lose all its gains over a long period of time in a single week. And as a trader, you have to make sure that you can actually protect yourself as well, and ensure that you have sound and risk money management in play to actually protect that upside,
downside,
because if the stock is creeping up and it's constantly going and creating high highs and higher lows, if you're not doing trailing stop losses or protecting some of the capital, then once it actually does reverse and you lose all its gains, your psychology changes, and then how do you actually play there and how do you recover from that?
Yes, a lot to unpack. All right, next stock.
All right, the next one is MMS. So this is Macmillan Shakespeare. Now, another volatile stock paying 9.45% at the moment. This stock's got some serious overhead resistance there, but there's plenty of room to that level. If we just have a look at where some of that resistance is going to kick in at around $18.20. But looking at it right now, what's interesting to me is even though it's quite volatile, look at this incredible nice line we've got down here in the sand. I mean, that's just beautiful when you put your trend lines, or you learn to put your trend lines in place. I don't want to be too pedantic about getting it exactly right, but we have rules around how you place trend lines to make sure that they're right. Because, for example, if you place it in the wrong spot and you don't know the rules properly, the stock could close above it and then reverse back down, and then we say the following week, oh, by the way, and this has happened with some students when they're first learning about this and learning to grasp the rules, is if they move the trend line into the right spot, they could have avoided getting into a false trigger.
Yes, yeah. But I mean, when you look at the stocks we've analysed so far, and we've got a few good ones coming, particularly high growth, so get ready for them. But when you look at these stocks right now, there's about 5 done. I'm not seeing any clean or clear trend in terms of they're all from financial sector, they're all REITs. They're pretty much across the board. In fact, I would argue some coming out of energy and materials, which is quite a promising thing when you're talking about our market. I mean, just last week...
That's what we want to go up, isn't it?
Yeah, you're seeing the full breadth of the market, which is so exciting. But anyway, we can discuss that later on.
So just on this, just a little bit further. So we've got some further upside to go on this, but like Zoran said before, you've always got to be thinking about the downside risk and where to get in. So by the time you get in, you've got to also justify the reward, whether the reward's there or not, and whether you're willing to take it below that line. There could have been an entry depending on what your strategy was, but let's just say that you were using this trend line as a rule to enter, and let's say you got in at around 16.54. Your stop loss, if you're using 15% stop loss, which you need to test, would be down here somewhere. I mean, by the time the stock gets back down to somewhere around that level, the chances are it's going down again. But any move above this point here, perhaps it could even go to that all-time high. It's quite possible that we could see Macmillan Shakespeare head back up to that all-time high, which is about a 34% return if it does get there. But it's just a question of whether this level here is enough to prevent you from wanting to get in or not, and that's weighing up the risks of that.
Yeah.
Next one.
All right, now we've got 4 stocks, 4 minutes. Can you do it?
Okay. Woodside Energy. Now, this is a higher risk play right now, given that it's been in that downward momentum phase. A nice trend line down here could be the key to preserving your capital. There's other rules that go in line with that, but as you can see, there's a fair way before it's even going to make that line yet. So don't be too gung-ho with trying to get in, that's all I'll say, but 9.45% is a nice return. Right now, I don't think it's worth taking that risk for that dividend return. SMR, Stanmore Resources, and you can chime in any time, Zoran, and help me out here if you want to. But you can see there another big downtrend on the stock at 9.23%.
Absolutely. I think one thing that we're seeing with a lot of stocks is actually a lot of them are downtrending at the moment, while some of them are actually consolidating and moving in a sideways range. Majority of them are actually trending downwards. But in this particular instance, I would like to bring something to your attention here. Looking at the monthly chart first, obviously, the bigger the time frame, the more significant the resistance or support level. I'd be actually focusing a lot on this level in particular, 150. It's nice round number, has provided quite a bit of resistance, created an all-time high on a couple of occasions in the past, in early 2010s and 2019, I would imagine. So if the stock can actually find quite a bit of support around 150 and again start moving sideways and create quite a bit of demand from the investors or traders side of things, then I think we could potentially get a bottom in. If not, then I'd be probably looking at lower levels on the stock itself. But yeah, falling knife right now, good yield. But again, what do you go for? Do you focus on the stocks that are actually just trending down, or do you actually focus on the yield, or do you combine the both?
Well, I mean, if you're asking me, then I would love to answer. But, to me, right now, the exciting part about all of this is because you've seen stocks that are falling. I mean, this one's fallen over 60, 70%. If we go back to that chart, the previous times it fell to that margin basically was deeming it for the long-term investor in terms of opportunity. So to me, that's where it gets exciting. There's no point looking at a stock running at up 300% in 1 year, looking at all-time highs and saying, hey, you know what? Today's the day for a long-term opportunity, because it's not maybe short-term plays, but the ones we're looking at here, huge yields, and potentially now with the nature of these falls, you're getting early to the party. I find so many times when a stock's being spoken about or ramped up online, it's done. You're late to the party.
Because they've got a vested interest in wanting to do that.
Right, or it's already run and the opportunity's gone. Whereas here, yes, maybe not today, but at least being early can give you some of those real life-changing returns. So to answer your question, I think it's more exciting than not looking at them like this.
I agree.
Rather than waiting until you've missed the boat.
Yep, I agree. All right, next one, SUL, Super Retail Group. Now, this one's actually fared a lot better, and these consumer discretionary type stocks should do well in an environment where interest rates are being cut. But at the moment, there's nothing there it's 34% decline. The yield's actually 9%, which is nice. And similar to these other stocks that we were looking at, there's this solid support level here, but you can see how it broke it. And this is what can happen at times with more volatility. The stocks will go through levels and come back up again and come back through levels and go back up again. Now it's a question of just waiting for a good set of rules to trigger, which you can back test on this stock. And then there's potential upside and good potential upside on the share. So not only a good dividend, but at least here, 25% to this next level and then 36%. And that's just a really rough rule of thumb from support and resistance point of view.
Fantastic. All right, next one.
All right, next one is FMG. This is one that we've all been talking about before the show. Zoran, did you want to weigh in on FMG and your thoughts on that with an 8.7% yield?
Yeah, one of the good quality stocks. Obviously, I would probably say top 20, top 50. Quite liquid, which is really good as well. Material sector obviously hasn't been performing the best, but like Phil said previously, we got to look at the stocks that are actually underperforming or sectors, and they can potentially provide their upside when things get better. So I'd be probably looking at monthly chart here to find quite a bit of support, which it looks like it has actually found. It's reversed quite strongly, which is a really, really good sign. However, looking at it on weekly chart, it hasn't provided any entry signals at the moment. I'd be also probably applying a downtrend line as well. Just one moment.
Now, FMG set themselves up with a great energy story, with hydrogen and all the other renewables. Yeah. So that's really exciting for FMG at the moment. And hopefully this will be accretive to the share prices.
Absolutely. I mean, if you can combine the both fundamentals and technicals to actually stick in the right direction, then, it's a great way to obviously capitalize and try to make most out of it. But the stock is looking quite good. It looks like it has found the bottom. I would like to see the price to actually appreciate and go above that level there, which is 17.11. If it can go through a long-term downtrend line as well, then there would be another clarity that obviously the change of trend may be imminent, and it could provide a long-term opportunity as well. But out of all the stocks that I've had a look at so far, it's probably one of my favorite ones so far.
All right, well, you took the words out of my mouth, Janine. Out of all them, what's your favorite?
Oh, I'd have to say FMG. Can I have another one?
Are you copying?
Oh, there was one more. Okay, FMG for now.
All right, well, if you want the skills to analyse stocks just like you've seen tonight, visit our website, wealthwithin.com.au. Now, moving on, let's now get into our hot stock tip for the week, which, Janine, I believe there is some huge news coming out of this stock. It's in the tech sector. NextDC.
NextDC is a nice one, isn't it? I mean, it's really been a popular stock of late, and there's been a lot of talk about data centres being so important, and there's a growth potential there. Well, they had some news announced, I think it was, whether it was yesterday or today,
yes,
about new contract wins,
yes,
which is fantastic.
Yep.
The only thing with that is that, and sometimes you can look at the good news and think, okay, now let's have a look at the share price, and it might have jumped up, or have I missed the trade? But no. Usually, you know, where these things come into play, these contracts, it's placed some years out. So it looks like 2027 or 2028 is when it really starts kicking in for them. But still, nonetheless, we're looking at the stats on market index at the moment and seeing right now that the share price is actually 13.6. It's actually up 0.95.
7% today.
7%. Sorry, today. So maybe everybody has jumped in with excitement, or on the news,
which is quite natural, given the news was positive. But I mean, when you go and take a look at that share price, which I know you're going to do next, I think you'll see that the opportunity might not have been missed.
Well, that has to be institutions making this move, because obviously a move like that's big, and they're pitching themselves, years out from now, obviously, and like these bigger sort of infrastructure type companies, which this could, even though it's more in the tech, it's still infrastructure for tech. So the 1 year return's actually -20 at the moment. It's had a 52-week range of 9.4 to 18.54, so we're sort of in the middle of all of that. And the stock, just looking at the information on the stock right now, we can see that the one monthly return is 27% at the moment, but don't be too concerned about that. But 2025 year to date's down around 10%. As I said, 1 year's minus 20%. Relative to the sector, it's actually negative 30%. So that says a lot, doesn't it? But what's interesting is the market capitalisations also. It's one of the bigger stocks on our market, so one that you could actually put in your portfolio. It's number 66 out of the ASX ranking of 2,324 stocks, which is nice. It's in that top 100 shares, or and sometimes what happens with these shares is they start to take off. They end up moving up indices as well. So we've seen it move into the 50, I think, at one stage. But I would actually keep a really close eye on this one. It's a technology stock, and that's what people are doing at the moment.
Yeah, and the tech sector, I mean, obviously it's been coming off a significant correction. This one wasn't immune to that, but I find it quite interesting given the fact that it's fallen 20%. Generally in circles, 20% is considered the end of a correction. If not, we start moving into 30, 50 and talk crash. So
20% is just this year, but if you have a look at the price chart, you'll see that there's actually more potential than sort of is indicated from that data, because it's fallen 50.
Wow.
Now, any stock that's fallen 50%, there's always a risk it could go lower. That's true. However, what this does is it puts the stock in a really great position for the average investor here, because we've got a nice resistance level overhead. If you're looking more medium to long term, you might decide to wait for it to get through that level. But if you're shorter term, at least it gives you an idea of where it might run to before it actually stops. So in the short term. So from here, we're talking $14 up. So it's another 10% or so before it hits that. But it may actually just trade sideways now. It may be that the news sort of pushed it up, and then the market will just sort of settle down. It's just a matter of wait and see, I think. But I'm quietly excited about it.
Yeah, Zora, did you want to add anything? Like, is there an opportunity for you right now on this stock, given it's up 7% today? Or, as Janine said, is it better off to potentially wait until the next one?
Depends on the time frame that you're trading, obviously. If you're trying to take the full advantage of the volatile moves and short-term corrections, then obviously, that's something to consider. But I agree with Janine. I think for a longer term, I would like to see maybe a little bit more pullback and consolidation. I would also probably like to see this gap getting closed around the $11. If you can do that and start moving upwards, then you could provide better opportunity on the monthly chart as well. If you're looking for a longer term, this is probably a key point for me. The November 1st, 2022 lows at $8.30. I think that's a major trough. And as long as the price doesn't go below that point, then we could potentially see some upside. But if it does break the major low, then obviously it could continue to go downwards. And obviously, as we know, markets go up in stairs and come down in elevators. So this is a perfect example of that.
Yeah.
I wonder how defensive this stock's going to be down the track when we have a major correction. I mean, just looking at the degree of the pullback that we've seen on it, but knowing that it's got those more infrastructure type assets under its belt.
Well, it's in the tech sector, and historically the tech sector
hasn't fared well in that
No, not at all. But anyway, that is it for our weekly hot stock tip. Now it is time to talk all things market trending this week. Now, Janine, I know you've got something very exciting.
Well, the exciting news this week is rate cuts. Okay, everyone wants them. NAB is apparently doubling down on the prediction for multiple cuts this year, including 50 basis points in May, citing that the RBA needed to catch up with global developments. 50 basis points this month and successive cuts to February next year. Now, in my book, any cut, particularly if it's 50 basis points or more, is a reason for investors to celebrate, as a cut this size would have a positive effect on your stock market, your portfolio, and let's celebrate now, shall we, or not? Is it too early?
It might not have a great effect on the Aussie dollar, which is, you know. But look, yes, I mean, look, I mean, for households and mortgage holders, it will be a nice relief.
Well, it means that people who couldn't afford one now, if it's a 50 basis cut, that's a serious cut.
Yeah. And
it allows more people to get into the market.
Yes. And you know, strictly speaking, or let's just say generally speaking, ease of capital increases, and then that generally bodes well from the business side of things. But I want to get your thoughts, because you deal in the currency side a lot, and you know, we're talking 50 basis points.
Big call. It's a huge call, I think, from NAB. I personally don't see that happening, to be honest. I'll take a contrarian view on it. I believe market is already priced in 25 basis point cut for the month of May. If we don't get it in May, then it's likely that we'll get it in July. And then on top of that, we are probably likely to get another 2 interest rate cuts until the end of the year. But to make such a bold call to get jumbo 50 basis point cut.
They got a headline.
I think that would obviously spark the market, obviously financial markets, to to trend upwards, and then we're probably likely to reach that or test that all-time high. I think obviously interest rate sensitive sectors could actually do quite well as well. It would add obviously a level of confidence into the market and consumers as well, whether it's housing market, consumer discretionary sector. But I personally, as I mentioned, I personally don't see that happening. I think from macro fundamental picture as well, we also got to take a view on what China is doing as well, being so closely correlated to China and doing so many exports, and obviously Chinese economy slowing down so much, and obviously with tariffs and everything else that's going on across the globe, I think there's obviously a case for concern over there as well. So dropping the rates could potentially help our economy, because Aussie dollar would, as Phil's mentioned, come off, which would obviously make us a lot more competitive in the export space when it comes to mining sector. And that leads obviously another question to maybe this is the time where material sector could actually turn around and start appreciating as well, which could help the likes of Fortescue, BHP, Rio, and the rest of the big players.
Yeah, time will tell. Now, we are going to have a look at the chart of NAB, are we?
Look, I think it's worth having a look at banks at the moment, given that generally when there's a decent rate cut, banks often are slow to come out and make that corresponding cut that the RBA makes, but they will appreciate because obviously there's more business that will come into the market. Now, at the moment, NAB looks like it's coming back to fill that gap, which is ideal. We want to see that happen, and a little bit of a pullback. So maybe NAB are going to get called out, and they're not going to get their 50 basis cuts, which is what we're thinking. And like Zoran said, probably more likely 25 basis points. But if we get any cut, I think it's going to be positive for the market. Hopefully NAB comes back to this point, moves up another 5%. Then we see NAB break out from this level. It's got plenty of upside, around 13.5% back up to that high. But just bear in mind that there are actually 3 highs up here around this $42 mark that NAB's got to contend with. So it's normal to see a pullback regardless of what was happening with Trump tariffs before these sort of highs occur. Sometimes they can go through and then pull back, but we're seeing a pullback before, which I like. So, a move up from here, we're looking right up into the 40s and possibly high 40s for NAB into next year. So that's what I'd be seeing up to the peak.
All right. Well, here's a question for both of you before we move on. If we do get a rate cut, let's say 50 in May or 25, do we make a new all-time high by the end of June?
No.
No. 25, I think market has already kind of priced that in. So initially, I'm actually, my view is that we might get a bit of a sell-off in terms of ASX if 25 basis point cut comes into an effect. But I think over the next few months, as we talk about further cuts, I think we will actually continue to move upwards. I also think that 50 basis point cut would definitely put fuel on the fire in terms of the ASX and probably boost its upside, definitely, yeah.
We're both smiling about
so let
that.
me break that. So let me just break that down simply. Was it a yes or a no by June?
No.
Okay.
We got a seasonality aspect as well.
Yeah.
So, you know, the famous saying, sell in May.
Yeah.
So I think that's going to come to some...
Yeah, I don't know about that Sally May. I mean, a market's come off since February almost 20%. I think the Sally May might not...
you don't believe so?
affect this. Look, given the nature of the correction and what we're seeing with the turnaround, I would be thinking the opposite
gonna take
this
off.
month. What do I know? All right, moving on. Let's now jump into more stocks and answer your questions. John writes, I would appreciate your advice on which ASX equities will allow me to best support a sustainable income. More specifically, I would like three things. One, to generate a reliable retirement income through interest or dividend returns. Two, to preserve all core capital, avoiding any drawdown of the principal investment. And three, to ensure that the portfolio continues to grow over time in line with market opportunities. I'm particularly interested in companies or funds with a solid history of dividend payments, strong fundamentals, and resilience across market cycles. Now, Janine,
big question.
We're going to address
Huge
this one. There are a few parts of this question that are quite interesting. And I want to address the first one, which is not wanting any adverse drawdown whilst collecting growth and...
You've lined me up for this one, haven't you?
Dividend. That doesn't exist in the market.
You just took the words right out of my mouth. So what I would say is 1 and 2 don't go together. 1, 2 and 3 definitely. But if you're looking for the interest rate, I think you said interest rate or dividends in 1. Interest rate, yes, and 2 could go together if you're looking outside of the market and just in the cash market. But dividends and 2 definitely don't go together because you're going to have drawdown. There's always going to be that risk that you'll have drawdown on your portfolio unless you think about it differently. And that is that you decide to yourself, okay, I've got this pool of capital and the capital that has to be absolutely preserved is a percentage of that. And recognising that you're always going to have, there's always going to be the potential that part of that capital will be drawn down as part of the volatility of the stock market.
Yeah, and I would even argue, I mean, if you're concerned about drawdown, David, then, I mean, you're a perfect candidate for someone who should be looking at the things we do in terms of the technical analysis. And because one major tick or feather in the cap of technical analysis and watching the price action of stocks and identifying and putting strategies on there in terms of capital protection as well with stops is that you can sleep easy at night knowing how much you're risking on each trade. So if capital protection is a concern and drawdown is a concern, then I would encourage you more than most to go and visit our website and have a really good look at what we offer.
Look, in one of the modules that we teach, this is in the advanced course, we actually model the whole portfolio construction side of things so that you can really see that. I mean, you will see that anyway. When you backtest stocks and you learn how to do that properly, you'll know what the potential downside could be at any particular point in time with any of the shares that you're holding. So that's really important to go through those exercises, but it's sort of a big question that he's asked, like you said, in terms of the stocks that you could buy if you're willing to have some drawdown, because even banks will fall. You know, they're probably the most defensive stocks that you could pick if you're thinking that way.
Yeah, you're going to have drawdown, whether you like it or not. Yeah.
Yeah, I think you guys summed that up, but it's a question of how much are you willing to risk for an upside? If you do understand what your bottom line is in terms of the percentage or dollar value, then that's going to help you be more comfortable with obviously investing and looking at the longer term picture.
I think the most important thing that anyone who's thinking like this can think about is to know how markets unfold and understand how they move, because if you do that, then while the drawdowns, if you know you've got stop losses in place like Zoran says, you're going to be less concerned about it, and going forward when the really big drawdowns occur, then you'll know how to protect and preserve that base capital you're talking about.
All right, well, thanks, John, for your email. We now have David's email. Can you please do a review of Guzman and Gomez? Janine, I'll get you to have a look at this one because new stock on the market, doing okay?
It's doing okay. I mean, you would think that, you know, being a food stock and something that's in high demand, obviously for a certain type of consumer, for example, because not every consumer is going to go there. But I mean, we've eaten it on the show. You know,
I quite like it.
Yeah, you like it. You're voting for it.
Yeah, it's for fast food. I think it's not bad.
I
think it's great.
Okay, so look. We're saying it's a positive thing. The products are good. It's just a question of when to buy a stock like this if you want to support the share price and potentially have an investment. But the challenge here is there's not really enough data to justify any sort of a medium to long-term position in it. It's more a shorter-term proposition. What is interesting right now is it is consolidating. Now, it's forming this sort of little pattern on the bottom there of this move, and we're just waiting now to see whether it breaks out. The real question is, where is the point to get in? You know, I mean, do you get in above here? Could you get in above there? Is it sort of, and then you'll be guessing if you don't have the right information to do it. But let's just say the entry point is actually there and it was $35 something. The upside potential on the share, if it does get going, could be something in the order of 20%, let's say, and a bit more if it challenges that high. So I think that the risk is reasonable with it, and depending on where you enter, I mean, Phil, you might enter down here. So I don't know, and then your stop loss is the thing. So if you're entering up here, where are you going to set your stop loss? You know, there's a 10% stop if you set it down the bottom of this pattern, which is reasonable given that you've got 20% upside and 10 or 11% risk.
Yeah, to me, I'm just thinking the whole time, I mean, if we had Pedro in the studio, he'd be able to tell us on whether the product is good Mexican food, given he knows all about that stuff. But he will be back next week, guys, I believe, so keep an eye out for him. Now, did you want to quickly mention anything on Guzman and Gomez, or are your thoughts similar?
Pretty much identical.
He's just thinking about the food now, yeah.
Yeah, I actually know someone, funnily enough, a bit of a fun fact. So I worked with someone up until recently who started working for Guzman and Gomez in Sydney, when the startup was actually happening.
Oh, really?
With the two guys now being billionaires, right? Because they're obviously listed on the exchange and stuff. So she was actually doing all their marketing and everything.
Did she get shares?
Unfortunately, she left before the shares were issued.
Oh, no.
And she never made most out of it, but it was an interesting experience from her point of view.
Well, look, just on that, right? Because so once the stock listed, look at what it's done since. Now, in the first 12 months, most stocks tend to trade lower than their listing price. So there's the open there.
Yeah.
It's trading, well, it's still trading above it. And for a while, it was trading up significantly above that entry price. So even after a stock lists, if you believe in the stock, maybe it could be a positive thing to do.
It could be.
You know, if you worked for them and you understand where it's going and what the plans are.
And I mean, just quickly to add, it's not that uncommon for stocks, once they list in the first 6 months to a year, they have that initial euphoric run and then they dip off quite significantly.
Which is what it's doing.
Correct. And then oftentimes that next opportunity is the better one.
Is the better one. I agree. Yeah. We've seen it with a few stocks like that over the years.
All right. Well, there you have it. Keep watching Guzman. Anyway, Alex's email is next. I have purchased CHC for a short to medium term trade with a 12% stop loss. Do you think a drop in interest rates in line with government-backed incentives to boost housing production and supply will support and increase the value of companies such as these? All right, Janine, now...
Yes, I mean, potentially. It could very well do that. And I think great pick. Look at it. It looks fantastic in light of everything that's been going on in our market. This stock has held strong. And I think you did a show previously where you looked at all the ones that were actually holding up.
REITs.
And this has done incredibly well. So congratulations, and I think there'll be more upside looking at that all-time high.
My only question, sorry, I'll get your thoughts on this as well, is with the REITs, when you're talking REITs, it's more commercial, and the incentive...
Well, the pressure's off as interest rates drop.
Yeah.
The pressure's off.
Yeah.
It doesn't matter whether it's retail or commercial.
Yeah, okay, fair enough.
Yeah, more demand in the market as well, more confidence. And it's probably likely that the rates will continue to go down and stay lower for a longer period of time. So this could be fundamentally a really good stock to look at, but also technically as well. I think the fact that it came back and obviously retested the low and now it's actually kind of broken through the most recent high, 1767, I can potentially see more upside on this stock. It's probably the best stock that we've seen so far in terms of the technical and fundamental playbook.
Now, when you look at that, is it, I mean, because it's pretty mature, let's say, in that recent run, it's been going up for almost a year and a bit. Are you attributing a short, medium or long-term opportunity where it sits today?
Short to medium, I'd say.
Sorry?
Short, medium, long.
Wow.
Yeah,
All
if I
three.
had another option, I'd ask you. Yeah, so for all, you think, yep.
I believe so, yes. The stock has actually made a major pullback if you have a look at it, even on weekly chart. And the fact that it's actually came back even stronger and broken through our through our most recent high, there's actually nothing really stopping it from going and testing an all-time high at $22.
Yeah.
If it can go towards that level, then obviously it's going to add more confidence into the investor side of things as well, from the institutional, probably the retail level as well.
Yeah.
And that could provide that opportunity with rates coming off as well to actually boost the share price to continue go upwards.
Great. All right. Well, there you have it. They really like that one, Alex. Good stuff. Now, Greg writes, it looks likely after the election that unrealised CGT will become a reality for 80,000 or so self-managed super funds. These funds are high net worth and would own a lot of equities. So what do you think the strategy will be now as the incentive for capital growth will be lessened? Is it possible dividend stocks with lower capital growth could be more popular? I can't see how it's a good thing for anyone, but your views would be appreciated. Now, I mean, this is a great question because what they're, I guess, offering or proposing, I don't know if it's come in or if it will come into effect, but
I think we will, yeah.
We're talking about taxing unrealised gains, and we know from the stock market just by looking at charts and what we show here on the show every week that it moves up and down more so than not in a volatile nature than what we saw even 5 years ago. So to then go and tax on a year-on-year unrealised gain, I mean, how much it affects the I guess, approach in terms of what you're looking for, to me, it doesn't change. I'm still going to be looking for growth regardless, because that's why I guess you come to the market to make money. So that doesn't change. But I mean, can it change?
Look, I mean, these things can always change. It just depends on whether policies get watered down or not. So I haven't read, the devil's in the detail. I haven't read all of the detail on this one, but I would suggest that you just have to wait to see it come out in its finality.
Yeah, and do you think, I'll get both your views on this, do you think that what he's saying in terms of the market, I guess, lessening off in terms of capital growth or growth opportunity because of this, is that a possibility that more people say, well, you know what, I'm not getting into the market because of this, like similar things that happened when they started to put the land tax on the property side of things? Look,
I think the amount of money that's in super in big funds is going to eclipse what's happening in self-managed super, although it's still significant. But there's also the funds outside of super as well. And I think when the market starts running, people are going to be thinking about what they can make, not how much tax they're going to pay. So I think that's what's going to happen. I take your point about the property side of things, but that only lasts so long. And it creates a situation where if, for example, prices did stall as a result of something like this, what happens then eventually, that gets pent up and it takes off. So like the property market in Victoria that's been held up by the land tax, once we start to see movements and these rate cuts come in, we will see prices appreciate again.
Also, go on.
Sorry, I just think one more thing. If people do start to, if this does come in and people start to think, okay, well, if I've got a profit and I've come up to the point where now it's time to pay tax on unrealised gains, they'll just close the position, lock in the profit and then pay the tax, which will probably add a lot more volatility to the market and make it more of a trader's market than it already is.
But this is also not applicable for everyone, I believe. So this is basically...
This is where you've got to get the detail.
Yeah, I think this is actually for 0.1 or like 0.5% of the actual investors or individuals out there. I think we're talking about implementing the additional tax on $3 million super and above in terms of the actual balance itself. So given how much obviously liquidity there is within the market, obviously locally and internationally, I generally don't see this drying up the market, if that makes sense. I still, the interest will still be there because there's still a lot of that, young investors that are coming through and mum and dad investors. So yes, it can have an implication and mindset change of an individual who's got that big account balance. But overall, I still think there will be enough liquidity.
The key is to understand the policy first, isn't it? To
Correct.
really understand that and how it's going to impact, and perhaps even speak to an accountant who'll be across that as well for you. But I wouldn't let that stop me from investing.
Yeah, absolutely. All right, great question. Now, Jules is next and writes, would appreciate your thoughts on Stockland Group. It appears to be forming an interesting pattern on the monthly chart, which is not dissimilar to the previous 3 legs in this uptrend. So given it has already had 3 legs up in this current run, should I be cautious? I like that it is holding its monthly uptrend line from the COVID low, as well as not having many significant resistance levels to the all-time high. Now, Zoran, you can have a look at this one.
Yeah, I can have a look at it. I see something interesting on the monthly chart here, definitely. I'm seeing sort of an inverted head and shoulders pattern, I should say. Not quite sure where it is right here, but that's generally considered obviously a reversal pattern in the market. Let me just see if I can mark it. So
you're getting very creative here.
Something along these lines.
Giving away all the tools, mate.
Yeah, so I mean that's kind of what I'm seeing, something on monthly chart very quickly, and then obviously there's a neckline here as well that we would need to apply to actually kind of see the upside break. But I would probably like to think that this stock has got a lot of upside. It's actually looking quite good. It's broken through a resistance level as well, and I think we can see quite a bit of upside here. It's broken through most recent high. It's got a nice uptrend in play. It's bottomed out. It's creating a medium to long-term trend, and weekly chart looks actually quite good as well. So I think this is looking really good. Some of these stocks last few that we picked, or clients or potential clients picked, actually look quite healthy.
Yeah, both reads, so quite interesting. All right, now Tristan's email is next. Saw yesterday's YouTube about IMM and wondered if you could do an analysis on PTX. All right, now, Janine, I know how much you love small caps.
Okay, this is exciting, isn't it? Because it's well below my dollar mark. It's in fact below 10 cents. So this is a very risky stock to be playing with, and it could be a backdoor listing, just looking at the chart there. And there are some major levels of concern here right now, and potential opportunity. And one is these highs here, could be one first important one. The next one is obviously the lows that are underneath all of that, and it's really scuttling along the bottom there, really struggling to get any traction. But is it changing, or is it about to change? Well, potentially it could be. It may be finding a bottom right now, but it's a high risk. There's no doubt about it. But if you're looking at this stock and you're considering, well, what's the upside on it? Could it get going? There's a potential there for more than 100% return if it really gets going, or somewhere here about 70% if it does. But the key is in how do you actually trade that, and that's the critical thing. There's some simple rules that you could apply to get in, and getting in is the easy part, let me say. The hard part is actually knowing when to get out, because often the stock will zoom up and then close right back down again on the bottom. But this is the monthly chart. For a stock like this, we really should stick to the weekly chart for now, once we've got those bigger lines marked of where the potential support and resistance could come in. And we're seeing this basing occur, which is a positive for it. You know, the fact that it's actually hit that level multiple times and is still holding there, it hasn't gone lower. I think it's actually got potential that it could start moving back up again. But, you know, where you enter depends on the level of risk that you're willing to take. And that may be a reasonable point to decide, well, okay, it's on its way again.
All right, so not just yet, but potentially above.
Not just yet.
All
Too
right.
risky.
Fantastic. All right, well, remember to send your questions to info@wealthwithin.com.au and we will answer them in next week's show. Now, if you want to watch more hot stock picks from us, check out our 10 ASX material stocks to buy before they surge video.